Many profitably running business collapse not because they're not generating sales or revenue, not because they are generating customers and market shares. They are struggling or falling because they are run out of cash. As a CFO, I saw many business profitably running business not able to pay employee salaries on time, vendors on time, because they not manage cash properly. In that sense, it's very clear that profit is a vanity and cash is a reality. Hello everyone, welcome to my channel. I am Gopalakrishnan. In this session, I will tell you a cash flow masterclass, which mostly into business class, teaching you how the cash inside the business is managing, or how the success coming from cash flow management. If you are a CA or CME student or a working professional or even an entrepreneur, this session will change the way you are looking into the financial statement. In real life, as a CFO, I've seen that many people assuming that, or they are thinking that profit is cash. Absolutely, it's not correct. For example, you are selling a product worth $1,000 or $100,000, and you are recording this as $100,000 as a revenue into that, and corresponding cost or cost of goods sold you are accounting as cost, and the revenue minus cost you are assuming as gross profit or profit, whatever. So in real scenario, are you generated the cash or generated the profit? In principle, whatever your accounted is absolutely is correct. There is no arguments on that. So revenue minus cost is equal to gross profit. From the accounting point of view, it's absolutely correct. But how this money is come to the business? It's really genuinely the profit is generated? Absolutely no. You have the credit terms with the customers. Even after the credit terms, you're not sure the customer is going to pay on time, or during the credit period the customer is paying or not, which you do not know. So until and unless the money is coming to the business, we cannot say that the profit is really generated. So from that point of view, revenue or profit is a vanity, cash is a reality. So let's see how the cash flow statements are prepared. Academically, mostly on the business schools and professional education system will teach us how the cash flows is calculating. Mainly cash flows are calculating in three major segments or categories. So like operating cash flow, investing cash flow, and financing cash flow. There are two methods also using mostly on how to calculate these three segments of cash flows. One is a direct method or an indirect method. So out of all these three major segments of cash flows, like operating cash flows, investing cash flows, and financing cash flows, operating cash flow is very important for any business activities or segments, because operating cash flow is related to any business day-to-day activities. Payment to the vendors, payment to the employees, utilities payments, so and so. If we are not paying to the vendors, what will happen? The vendors will not be paying materials on time, which can affect the business operation and disturb the activities, disturb the production. If you are not paying the employees, people will not be coming on time. People will search for the job. So people to be on, the employee salaries to be paid on time. We know that many companies are, as we mentioned, that they are struggling, or they are not able to pay the employees on time because cash flows management failure. So as far as operational cash flow, it is very important. Operating cash flow should be always positive in real sense. If cash flow is going to be a negative situation, it's alarming to the business, it's alarming to the stakeholders, it's alarming to the vendors, employees, utilities, government agencies, all, because it's affecting the continuity of the business. Out of all these cash flow statements, out of the cash flows scenarios, all the stakeholders, mostly the owners, even the financiers, they're all looking into that how the operational cash flow is managing and what is the real scenario. In a situation where negative cash flow is coming to that, banks may say that please come and pay our loans back. We are not trusting you. We have not faith with you that you are managing the business professionally. So this is a situation where operating cash flow is very important, and it is a responsibility of all the officers in the business to make sure that cash flow is managing properly and more emphasis on operating cash flow. As far as investing cash flow is concerned, mainly all the monies which you are spending on investing related activities, which is mainly for not the operational activities, but investing activities, mainly on the purchase of assets or acquisition of assets, plant and machinery, long-term lease, which is a part of assets. Any amount which you are paying for investing related activities is classified as investing cash flow. And the third category is financing cash flows. The name itself is very clear that it is financing activities. Where the financing activities involved, mainly the money is coming to the business, mostly in the form of equity or for long-term financing. If something is coming in the form of less than 1 year, which you will be taking into operating cash flow. For example, we are getting credit from the vendors. This is also a financing activity, but that amount that we need to repay to the vendors within a year, mostly all these cases, vendors need to be paid on time, and the credit may be mostly less than 1 year. So financing activity is nothing but all the monies we are paying to the financing activity. For the example, the monies come in the form of business, which is capital, and the money which you are paying to the shareholders, which is dividend, or the money which you are paying back to the shareholders in the form of buying back shares. So all coming in the form of financing activities. As a CFO, and mostly all the CFOs mainly concerned about the operating cash flows and they are concentrating on the cash conversion cycle. So what do you mean that cash conversion cycle? Let's understand what is cash conversion cycle or working capital cycle. So money, when we are investing into business for the day-to-day activities, we are putting money into the business, which is going in the form of purchasing material, converting into the raw materials into the production work in progress, the work in progress converting into produced or finished goods. Then we are selling that product to the customers in the form of receivable or cash, and the money is finally coming back to the business in the bank or it is coming in the form of cash. Nowadays, mostly our money is coming into the bank because of the government regulations, how to control money laundering, prevention of. With that, we have a specific local anti-money laundering laws, so and so. So still the money is coming back to the business, that is showing as a receivable. Mainly we are calculating the working capital cycle or cash conversion cycle. Basically, simply is a cash conversion cycle is the flow in which the money is starting from the point and how the operation is going through that, and when the money is coming back to the business, which is called the cash conversion cycle. For that, there are different elements are involved, such as a receivable. A receivable we are counting in the form of a receivable in days. For example, we are selling goods to the customers. They will be paying they are paying money back to the business in a specified number of days, which is the credit days. So the credit period is very important, and how long the product is lying in the form of inventory. So we have produced the goods and spending so much of money, material cost, conversion cost, for example, labor cost, overheads, all that we incurred for that, which we paid for that, and we spend money and the product is in the form of work in progress. Still the goods is not converted into a finished product. So after all the remaining activities of production, the final material is coming into the warehouse, and you are keeping this product for some times in warehouse. The money is held up in the form of inventory. So what is the period in which the money is held up in the form of inventory, which is called inventory holding days. And next session is we are getting some advantage on that. For example, we are purchasing materials from the vendors, and for that we are getting certain benefits, like we are having credit facilities for that. We are not paying immediately to the vendors. So we are getting credit periods, which is nothing but within how many days we are going to pay the vendors. That is called payable days. So this is a sum of the working capital cycle, or in the form of cash conversion cycle. So cash conversion cycle is basically the cycle from the cash started and how the money is coming back to the business. It can be represented in the form of receivable turnover days plus inventory turnover days minus payable turnover days. That means how long the money is available in the form of receivable, that we are getting the money from the customers, and how long the money is we are invested into the inventory, and what is the money's benefits which you are getting from the vendors or creditors. The formula is receivable turnover days plus inventory turnover days minus payable turnover days. Business does not fail because of low profit. Business may fail because of poor cash discipline. Example, you sold a product and generated a profit of 1 million, and you have a receivable or an outstanding which is 1.5 million in the market. So in that case, the 1 million profit which you are showing in the profit and loss account, which is really generated in the business, which is profit which is showing 1 million, and receivable is showing which is more than 1.5 million, which is not at all a profit in terms of cash, and unless the money is coming back to the business. So what happens? Cash shortage, that is keep on continuing to the business. So this is the reason I mentioned that most of the business wherein the profit generating business, most of the business where the profit generating business falling not because they are not generating profit, they are falling because low cash management system. Remember one thing from today: a cash business growth without cash control is a financial suicide. Growth without cash control is a financial suicide. What is the meaning? From all these examples, which hopefully you understood that. Business earning profit which you are not able to control the cash, then there will be a crisis, and which can lead to the fall into the business. So scaling business without a working capital planning is a dangerous in many situations. So cash flow management is an important element in financial management. Scaling the business, increasing the earning potentials, earning profit, poor cash flow management system can lead to the fall of business. In the coming session, I will tell you how the cash flow is calculated practically and how the CFOs monitoring the cash flows and safeguarding the interest of the stakeholders of the company. And this session hopefully it is interesting to you. Please like, comment and subscribe my channel to make sure that all my coming lectures are reaching to you on time and you can watch it on regularly. Please remember that cash flow is not an accounting topic, it is a survival to a business segment. Thank you and see you in the next session.